All right, welcome back everybody to session 4 of our book club. If you're new to this, we are recording the session, and we post this, I guess, on YouTube amongst other places. So be aware that you're being recorded. We are primarily a group of, I'd say, Morningstar thought leaders, but with a mix of industry gurus. Try to stay on mute, but if you'd like to join the conversation, we want this to be as conversational as possible, so please chime in. If you're having any sort of technical difficulties, I have got 2 emails listed there for Spencer and for Tal. You can try the chat too. Compliance always wants me to say or open up with, this is not advice, but of course, it's a book about how to give advice. And then we will be meeting next week, and then we're going to have 2 weeks off. So the 22nd, 27th, and June 3rd. So the 27th is Memorial Day, so we'll be skipping that. And then we'll resume back on the 10th. But we're still on for next week, May 20th. We'll see how far we get today, but speculating about what we'll cover there is, I think we'll get through chapters 5 and 6 today. At least that's my hope. And then I think the reading assignment will be what's all of part 2 of the book, which was chapter 7 and 8 for next week. But we'll see how far we get today. Maybe I'll start and just briefly pause if anyone had any questions related to material we've covered thus far. Otherwise, I'll kind of keep us moving here. I find the first time I click on my slides, they don't want to go because I've shifted focus somewhere else. So where are we in terms of reading the book? We are almost done with part 1 of the book. Of course, there's 3 parts that line up with the different elements kind of our model. We've been covering a lot of, I'd say, precursors related to information that's necessary, techniques that are necessary in terms of developing a life cycle model. And we're at the beginning of chapter 5, which is a life cycle model kind of in a deterministic world. And then in chapter 6, we move to introducing uncertainty into that. Have not reviewed these learning outcomes, but in case people want to teach this as a class, we've tried to put forth a few learning outcomes. And Paul, I plan to let you drive the ship.
Okay, so we're ready?
We are ready.
Let's move on. Yeah, let's go to the next slide. Okay. Okay. We're jumping right into it here. Let me say a little bit about chapter 5. So in chapter 5, we create a model where there's perfect certainty. There's no market risk. The market just returns a constant riskless rate of return. And the reason that we do this is because there's a lot we can learn by kind of holding back on introducing market risk and going into the problem shown here, which is equation 5.1 over there, which says what we want. This is our lifetime utility maximization, and what do we want to maximize? Well, we're going to weight by survival probability, and we're going to discount by the subjective discount rate. And that's going to multiply this utility of a particular year, let's say a year in consumption, and that is consumption in excess of non-discretionary consumption. In other words, the utility is being derived from discretionary consumption. And this is subject to a budget constraint, which tells us that the present discounted value of non-discretionary of discretionary consumption has to equal financial wealth plus human capital minus consumption-related liabilities. And this is basically this is an equation form of what is essentially the discount, the balance sheet, the economic balance sheet of the investor. So what we have on the left is basically the kind of the market value of future consumption that has to equal net worth. Okay. Now, the fraction of which how much is someone, in this case, we're talking about Isabella, what fraction of net worth is actually spent? And this depends upon whether there's mortality weighting or without mortality rating. Well, so without mortality weighting would be the situation in which Isabella does not have annuities available to her. She cannot annuitize. And that's going to have some consequences, which we'll be talking about when you cannot annuitize versus when you can annuitize, at least annuitizing once you reach retirement. And that leads to you know kind of a bit of a different path. Both of these are increasing. You spend a larger and larger fraction of your net worth each year, but it's greater with mortality weighting, or when there's annuities, and that makes sense because if you have annuities, basically you're going to be able to generate more income. Okay, so now what's the evolution of consumption over time? Three different cases. So one is when there's no annuities and no life insurance, then it's kind of straight for a while, and then it starts curving down and comes way down, at the end here. And why is that? The reason for that is because when if a person has no annuities available to them and they're planning out their future consumption, they're going to, they're not going to want to plan on having a lot of consumption in a time period when they might not be alive to enjoy it. So this is the consequence of how mortality impacts the consumption decision when you don't have annuities. But when you do have annuities, you're able to really smooth that out, and you can plan on your level of consumption being consistent. It's consistently increasing over time, because that's what annuities allow you to do. Now, if you have life insurance, that's a little bit lower because we're going to be leaving a bequest when you die, so you can't spend as much when you have life insurance. Okay.
And Paul, I was
Next.
going to interrupt you actually. Again, I don't know if you want to talk a little bit about, say, the annuity puzzle. Again, I guess to me, this is at least, one view of what this kind of puzzle looks like, which is that, with annuities, one can really consume, especially later in life, a much larger amount of money, or, at a much higher level. And without annuities, as one is moving through retirement, this, the downward kind of curve or slope really kind of kicks in here. And again, I guess I feel like people would look at, well, if I could have that level of consumption, wow, that makes total sense. I would rather have this high, smooth, constant consumption level, as opposed to having to worry and fear that I'm going to run out of money. And as a result, I guess you're, consuming less and less and less as you age. And yet, again, so many people end up, not purchasing annuities.
Yeah, so that's the annuity puzzle, because economists love annuities. We say, it's like you should use annuities. You should be, so you don't have to worry about, running out of money very late in life, because once you buy that annuity, you've locked in that consumption. And yet, of course, what we know from the data is that people hardly buy annuities. They don't
And
buy very many annuities. So
again,
that's the puzzle. I
so
don't
with
think we're
annual
going to solve the.
no, we can't
Yeah.
solve it because people still don't buy them. But annual consumption is here. Again, the gap between what you end up probably consuming in the non-annuity case versus the annuity cases, becomes substantial, especially later in life.
Yeah. All right. So that just shows the annuity puzzle. Now, also, we can see some differences in the three cases with the evolution of financial wealth. So financial wealth, we know that, from, let's say, Isabella's 25 now, and she's going to retire at 65. So over the next 40 years, she's going to be building up she's going to be kind of spending down her human capital will go down. And in fact, she's converting her human capital into financial wealth over time. and that reaches a maximum here at age 65 when you retire, and then you start to spend down your financial wealth. This is what makes it possible to get to that kind of smooth consumption line. Is the fact that you first, you when you're working, you save, and when you retire, you spend down. And of course, the curves are going to be a little different here in the three different cases. So, uh, without annuities and life insurance, we see is that middle one, uh, and then with annuities and without life insurance there, and then we see with annuities uh, and with life insurance, which is the highest one. So we're gonna talk a little bit more about some of the details kind of underneath, what's below, what's kind of going on below those curves. And we created this diagram, which kind of summarizes it all, because what it says is that first of all, uh, Isabella plans on leaving $1 million when she passes away. She just to somebody or some or some organization or something. So what does that mean in kind of her? So we can see like from ages 25 to about age 45, she's accumulating wealth, but it's not annuitized wealth. It's just what I would call like conventional wealth, just investing in securities, which in this case is the only security there is. It's the risk-free asset, but with no annuity features. And why is she doing that? Well, she's doing that because that's how she's kind of building up to this goal of being able to leave $1 million. And which before she's reached that goal, what is she going to do? Well, she should buy term life insurance. Now, I guess there's also some life insurance puzzles as well, because this is saying is that when you're young, you're working, and you want to leave a bequest, the right instrument for you is term life insurance. And every year, you should renew your term life insurance, but by a decreasing amount. And you're just buying the term life to fill in that gap, that green area, that gap between the $1 million green line and the blue area of your regular financial wealth. At some point, you're going to reach that. And but the way we set it up here is that for the next, let's see, from about age 45 to about age 60, she's still going to be building up conventional assets. She's not buying annuities yet, because we made an assumption that she's only going to buy annuities once she's retired. So before that, she'll continue to accumulate in regular assets. But then, once she's 65 and she's going to retire, she can convert those regular assets into into we would call like annuity wealth, and basically buy annuity. So now she's got $1 million in, say, ready to go there. And at this point, she has annuities, and she's going to live off annuity income. So one of the things you also notice is that you don't buy life insurance and annuities at the same time. You would, in a model like this, you first you buy your term life, you accumulate, and then when you don't need to accumulate, and then when you're ready, you can switch to annuities.
And so, Paul, kind of a question that I was asked in a different context, was related to kind of at least for Isabella, right? She's kind of an asset accumulator, and then she's a retiree, which is perhaps the standard way people think about, maybe even in life cycle finance, of working and then retiring. But there's can be maybe a gray area where people are retired from one job and then working like a part-time job, and they're not quite retired. And I guess the essence of the question was are the models of life cycle finance able to kind of deal with a non-standard, this work and then retire? Are they flexible enough to accommodate maybe more in between cases?
The answer is yes, because actually the model itself does not really make an assumption about where income comes from. I mean, we've kept things simple here by assuming, that she earns wages until she's 65, and then she collects Social Security after that. But there's certainly we without any change to the model, the actual model, just changing the numbers that go into it, we could say that she works part-time for 10 years or whatever, and that becomes part of her income, and all that would be impounded into her human capital.
And I think this is the
Okay,
final slide of chapter 5.
this is the slide on chapter 5, which is we just talked about a bequest. Well, we wanted to come up with a way of saying that that the decision of how much to leave a bequest should be kind of similar to other decisions, how much to consume, in particularly. And so what we do is we take all the consumption over the lifetime, and we solve for what level of consumption would constant level of consumption we give the same level of utility. So that's our constant equivalent consumption on the vertical axis. On the horizontal axis, there's the bequest, and we see a straight line, which is a budget constraint between those two. And then we have a set of indifference curves, where the tangent one then determines how much of a bequest we're going to leave. I mean, this chart is essentially the same as our pizza and beer chart that we showed in the first session, or our consumption today versus consumption tomorrow chart, or consumption up market versus down market. It's just that here the two goods, the two things we care about are basically consumption and bequest. And so this gives us a way of using utility theory to once again solve a problem, a decision problem.
And
Okay,
so,
now we're going to move on to chat. Yes, yes.
Tao, it
So,
sounded like you maybe had a question.
yeah, Paul, can we go back to the previous slide? So, Paul, I'm curious that here, when we're looking at this 3 indifference curve, we're basically compare the consumption and bequest trade-off, meaning the trade-off between how much you're going to have for the discretionary spending versus the same $1 million of bequest, right? So I'm wondering, is there a way for the model to, I think maybe that's a flexibility part. So yeah, so if that's the case, so I would like to maybe confirm. So to me, it feels like at some point, maybe the investor will modify their bequest preference a little bit. So instead of having $1 million of a bequest, they might only expect $500,000 of a bequest. So are they the same, or how do you think that if that dynamic can happen, how do you think this the model can incorporate?
Yeah, so one way would be, I mean, you can just pick a number, million, 500,000. But what we're trying to do here is we want to cast all the decisions the investor is making, as a utility maximizing problem. So what we in this chart is just showing how, depending upon how much you emphasize a bequest, the more you emphasize the bequest, the higher the bequests that you're going to leave. So the 15% one, has that fee equals 15%. That means they have a stronger bequest motive. So they end up like about $1.5 million. And then 1.5 takes us down to about less than $1 million. And then the 0.1% takes us to less than $500,000. So this is just a way of tying, the number that we come up with for the bequest with utility, basically with utility theory. But we don't have to. I mean, we could have also just picked a number for the bequest.
And again, I guess, Isabella's preference related to bequest, might evolve over time. And the way I might, like the moment, right, when we started off, she's 25, and remember, she's working with Paula, and hypothetically, Paula is using a new integrated financial planning, investment management, software system that doesn't actually exist yet. But, part of it is this holistic investor profiling system. And so kind of like in the spirit of a risk tolerance questionnaire, if you'll remember, we've extended or suggested additional types of questions that would get at these other preferences. I would imagine that, anytime there's kind of a life-changing event for Isabella, she should be updating kind of her preferences. And it might be that, by age 30, maybe Isabella's had a couple of, children, and her desire to leave a bequest is, quite high. And then maybe, by the time she's 65, maybe she's had a falling out with her children or something. I don't know. And her preference might change, but through time, it may very well be that Isabella's, preferences do evolve. And again, that's, part of knowing your client is hopefully Isabella is, returning to work with Paula on a regular basis. And as her life circumstances and preferences evolve, she would be updating those, and that preference used inside of the utility maximization model and based on Isabella's circumstances would be generating what is the amount of that bequest based on the two preference-oriented or bequest-oriented preferences.
Makes sense. So I think maybe following from this train of thought, I'm also wondering, so here, currently what is being done is we assume there's a 1 million or 500 or even 1.5 million dollar bequest to start with. And then we're trying to determine what is the level of discretionary consumption that will maximize the utility. And would that be possible? I think maybe I just want to kind of confirm, and maybe another way to do it is, what if we say, hey, this individual just want $50,000 of discretionary consumption on top of that non-discretionary spending? Can we, I think maybe there's a way that for the model to determine what is the optimal level of bequest to achieve the maximum utility.
Yeah, well, you could do that, but that kind of turns the model on its head, because the main point of the model is that you should vary your consumption over time, according to life cycle theory. And if you just say, well, consumption is going to be some fixed amount, then of course you don't need the model anymore. So. And then there are other consequences too, which I think will come in the next chapter when we're talking about uncertainty. And there's a whole literature about spending rules to try to prevent running out of money before you die. And with not a whole lot of theory behind that. But that's kind of what life cycle theory is addressing. It's saying there's an optimal path of consumption you should follow, based on your preferences and your resources.
And so, Cal, I think the way you're setting up the problem is the way people typically set it up, which is that it's kind of like, hey, I have an amount that I really want to give, and that's the way they think about it. And again, I guess to me, this is not the way people currently think about it, but there is a way, in an optimal way, to try to size that bequest, as opposed to come up with an arbitrary number that I want to leave $100,000 to this person and $250,000 to this person, or whatever it happens to be. It would be based on your circumstances and how you feel about, bequest versus your own consumption, arriving at what that bequest number should be.
Yeah. But yeah, thanks for the insights. I'm good.
But and maybe we'll touch on that more. And now I'd say we enter what I think is, at least for me, I'm mathematically challenged, and I would say this is the most mathematical of our chapters, and probably where people will feel I'd say maybe the least comfortable. We probably have a number of equations. I I'd also say we probably have two types of audience members. Those that will be interested in trying to actually apply the models, build the models, replicate the models, and do the math. And then I think there's another group of people who want to be users of the models, have a high level understanding of kind of what they're doing without knowing the math. And so hopefully those that are in that kind of second group will bear with us as we get into some of the numbers here as we move forward.
All right, let's yep, next one. Okay, stochastic discounting factor, or the pricing kernel. This is a concept which is very familiar to people who take PhD level finance or financial economics courses, and not as familiar to people who who haven't taken such classes.
And I would argue, like, even people that get a master's in finance probably don't have much interaction with kind of the stochastic discount factor or pricing kernel. It's really for those that go on to pursue a PhD. But keep going, Paul. Sorry.
Yeah. Okay. No. Yeah. So, but I mean, it's actually a pretty simple and elegant idea. So if you think, yeah, like it's a stochastic discounting factor as opposed to a deterministic discounting factor, because normally when we do discount math, we come up with you come up with a discount rate and you apply it, and then how do you and then of course there's a whole set of questions about, like, well, how do you come up with the discount rate in the first place? Well, here the idea is that in the market for, let's say, for risky securities, the way that this works is that there's a stochastic discounting factor. So in every state of the world, the discount rate is different, and in every state of the world, a security might pay a different amount of money. And so you basically multiply the discount factor by the amount of money. You look at that in every possible state, and then what you do is you take the expected value of that. So basically, you're taking the probability weighted average of those numbers, and that gives you the price of the security, and that's the price of every security. It's in order to price a security, you need two things. You would need, first of all, the the model of what sort of cash flows that security produces, and you would also then combine that with the stochastic discount factor, which is determined by the market, and you combine those two things, and you could price any security that there is. So that's what I mean. It's sort of simple and elegant in that way. It's so a lot of stuff we learn in school about DCF, discounted cash flow models, and it's just a single discount rate you have to come up with to use it. But in the stochastic discount approach, there's a complete distribution of possible discount rates. And I'm not going to go into the details here. This is just a numerical example of how it works. That is the SDF itself. In the first row, we're trying to price an asset, what that asset pays in each and every in every asset, and then like I said, you multiply the SDF by the payoffs, take the expected value, and you've got the price. And you can convert that price to expected return as well. Okay, let's move on. Dynamic programming models. We put this in here really as a I think in the book it's a sidebar, because we always get asked the question, well, why don't you use dynamic programming models? Well, they're not easy. They're easier said than done. These models they can get quite complicated and quite unruly. So the more variables you have, the more different constraints you want to include, and so on. So So what we do, and the next is, yes, Tom found the front page of my PhD dissertation, Northwestern, 1986. I won't bother with the title, but basically, it was when I wrote this dissertation, and I wrote this dissertation under the influence of a paper by Robert Lucas, published I think it published in Econometrica in 1978. And I kind of figured this out. Now, what I was doing in this dissertation was I was not trying to create a model of actual like investors, households, but rather what I was doing was I was creating a simplified model of investors in an equilibrium model. And so a lot of the machinery that I sort of developed in here, I've carried over actually over the years until kind of finally bringing it into this book on how to do this. Except instead of trying to create an equilibrium model, I just take the SDF as given. Assume I just know its distribution somehow. Okay. So the important thing here is that we're assuming a complete contingent claims market. The investor can buy a contract with a payoff at any time in the future that is based on any contingency. And I always like to give the example that says, I could buy a contract right now. I can go to the market and buy a contract. It will have a price that says that I will be delivered one umbrella on Tuesday if it's raining. If it's not raining, then I don't get the umbrella. So that's the idea of it's contingent on what state of the world we're going to be in. Okay.
And Paul, I'm going to jump in here. I think for many people that study life cycle finance, again, the typical way to solve life cycle problems is through a dynamic programming approach. And for those that are familiar with dynamic programming, for them that's kind of the only way to solve such a problem. And for them, I would just say it's arguably very intuitive. Again, sometimes it does make kind of the intuition behind the model a little bit harder to see, but again, the important thing is that, again, I think due to dating back to your dissertation, there is in fact another way to solve these types of problems, and it's arguably extremely elegant and efficient, and does not mask the intuition behind the problem that you're attempting to solve.
No, I think the plus is that it is sort of a more understandable approach because dynamic programming has to be solved numerically. It's not like you have a formula for it. But the downside, I mean, you have to give up something, right? And what we're really giving up are all sort of the real world constraints that would be on investor. The fact is, investors do not have a complete contingent claims market to go buy securities in. They can only buy the securities that are actually available in the market. They can buy stocks and bonds and things. But this does really kind of help with it. We're going to have utility function here, which in this case is modeling. Well, the way it's written here, it does model the intertemporal substitution, but it's also modeling risk tolerance, and we're gonna break those apart later. But really, what you see in that equation is effectively what I had in my dissertation, which was the idea that you take expected, since consumption is random, you have to take its expected value, and that as a consequence, you end up with this second equation, which tells you how your consumption should vary from one period to the next, depending upon the realization of the SDF, which is I denote by Q tilde. Okay, then this is going into the risk again, constant relative risk aversion, and constant relative risk aversion, of course, has a nice property that this equation pretty much simplifies. And I think if we go to the next one, yeah, then we can get then we can actually write a formula. Now, consumption here is discretionary consumption. But the idea here is that it's related to the realization of the SDF and inversely. Now the little bit of the thinking here, the SDF itself is going to be a high number. It's going to be fairly high in bad states of the world, because in bad states of the world, getting another dollar of consumption is going to be much more valuable than in a good state of the world, where getting another dollar of consumption is not as valuable, and that's why this relationship is inversely related. So in good states of the world, Q tilde, the SDF there, is going to be low. That's so inverting that, this inverse relationship says you're going to increase your rate of consumption, and then if in bad states of the world, you're going to lower your consumption. You're going to lower your consumption. So that's just kind of the some of the thinking behind this, that and it's getting to kind of one of the first lessons of this, which is that we were talking earlier before about models that just assume you have a constant rate of consumption over time, and the problem you have is that you might, if you spend that amount of money, you might run out of money before you die. Whereas what this is saying is that you should vary your consumption depending upon kind of what's happening in the market. So when things are good, when your assets, the value of your securities you own are going up, spend some more, and when they're going down, spend less. So now this is just expressing that idea. It's just in terms of the return here. So this means the return on your net worth. And of course, so once you express it in terms of return, you can see it's directly related. You increase your discretionary consumption, good returns, you decrease it with bad returns. Okay, now what we can do is, because we have this little model that says, what kind of returns should someone have depends upon their risk tolerance parameter, that theta parameter. And then what we do here is we simply look at basically like different investors, each one having, let's say, going up that line, having a higher and higher level of risk tolerance. And the more risk tolerance you have, you hold riskier assets, and so the standard deviation is higher, and they have higher expected returns. So now we've translated this kind of world of uncertain, of contingent claims markets, SDF world, and we're now expressing it in the language of Markowitz, and it has the same interpretation. This is just showing like some random paths of returns for one, for different levels of risk tolerance over time, and you can see, of course, they all move up and down together. But the more volatile, the most volatile ones are for people with high risk tolerance, and the least volatile ones at least with the least risk tolerance. And then the next chart is to show you how that might translate into consumption or spending here over time. So again, you can see how your level, if you have a low level of risk tolerance, it's flatter. If you have a higher level of risk tolerance, you get more of a bigger move over time. Okay.
Paul, that was still discretionary consumption, right? Just wanted to.
Everything's just, yes,
okay.
That's right.
Thanks.
All
just wanted
discretionary
to double check.
And Paul, from the past few slides, we're only looking at maybe one trial of the simulation. Like
Yeah,
once,
well, we're looking at a very simple simulation here. It's just, you can see, yeah, it just goes from year 0 to year 70. But it's very simple. It's just, discretionary consumption. No, we haven't taken human capital into account or
sure.
anything else. We're just trying to get a feel for, how as returns unfold over time, what impact that might have on someone's consumption.
Sounds good. Thanks.
Okay, now the certainty equivalent return on net worth. This well, what if I say what it is? It's that when we're going to talk about the spending rule in a moment here, and this in the spending rule the chapter, the spending rule in chapter 5 is based upon the risk-free rate. The spending rule in chapter 6 is based on what we call the certainty equivalent return. And what it is, it's the constant rate of return that would make the investor indifferent between that constant rate of return and the risky rate of return. So it's a kind of a utility measure, but instead of measuring it, in utility, we're measuring it in return, and that's what makes this into a useful calculation. We call it H, and in this formula here, let's suppose, okay, ER, we have an expected return, we have a logarithmic variance of around that return, and we have theta, the risk tolerance. So what you can see is that it's less than the expected return because it's x of the minus this term here. So you can see the more risk, the less it is, and the less the risk tolerance. You can see how that all impacts. So this is going to be important, because in effect, in a way, this actually in more than one way, we're going to talk about how this kind of replaces the risk-free rate in some of our formulas. Now,
Oh, good question.
yeah.
So starting from last slide, 127, I think we're moving from one simulation trial, one iteration of the real world, to more generalized, will be the certainty equivalent return of all the future states.
That's yeah. The
accurate?
certainty equivalent is I mean, it's a constant.
Kind of sum up all the
right?
all the trials.
Right. So as long as our assumptions about the market and about the the market, expected return and logarithmic variance. So that's about this. Let's say you can think of this as some security or some portfolio that has this expected return and logarithmic variance, and then we combine that with the with risk tolerance. Yeah. So yeah, and you can see when risk tolerance is low, this is going to be much small. This is going to get smaller, much smaller than the expected return, and risk tolerance is higher. It's going to be higher, but it's always going to be less than expected return. And that's important because sometimes in certain calculations, people will put in the expected return on something, but it's not always the expected return. It can be this sometimes. So we'll get to that on the next slide. Okay, so this is so first of all, when we're talking about these curves here, what we call this rescheduling factor, that's how much the investor, will reschedule their consumption from one period to another based upon their longevity, their survival probabilities. And it gets raised to the power of the elasticity of intertemporal substitution. So the higher that number eta is, the more you'll see like substitution of consumption across time. Now, this formula here is relevant for when there are no annuities. And this is what when we develop the spending rule without annuities, which is shown in the bottom here. See if I can move this. I'm trying to move my Zoom. My Zoom is blocking it. Oh, there we go. Well, okay. So this factor I call it capital delta. That's what I'm calling the consumption divisor. So the optimal rule for discretionary consumption is to divide net worth by this value. And it sort of has two main terms. One, it has this rescheduling factor in it, and that's when there's no annuity. And the other term is this kind of a term that has a growth rate in it, and it has an H. It has the elasticity of intertemporal substitution. I'm sorry, it has the certainty equivalent return in there. And that certainty equivalent return is functioning here as a discount rate in this calculation. Now, when there's an annuity, we basically don't have this rescheduling factor, because when there's an annuity, when you have annuities available to you, you don't face this problem of having to move consumption between, decide between consumption in former years versus latter years, because the annuities will help you smooth that out. Okay, all right. So this is just showing the certainty equivalent consumption is a distribution, and without annuities available and with annuities available. So this is the constant rate of, this is a constant rate of consumption, which if you were to consume this level of consumption in all periods and in all states, would give you the same level of utility as the one you're actually going to get, as things vary over time. And this is going to be an input into our this is going to get back to our bequest idea. Okay. So here we go, basically the same chart as we had before. The difference here is that instead of it simply being the constant level of consumption, it's the certainty equivalent discretionary consumption level. So it's taking uncertainty into account. And you come up with an optimal level of consumption. I mean, of bequest. Okay. All right, now IVAs. Okay, immediate variable annuities. So of course, an IFA is what we have in chapter 5, where an annuity pays some constant amount. Here, what's going to happen is instead of these annuities, instead of paying a constant amount, what they do is that they look at the cumulative value of an underlying portfolio. They compare that against what's called the assumed interest rate. And basically, when when this portfolio goes above in value, above that assumed interest rate, then you get more. When it goes below, you get less. Now that assumed interest rate, which we talk about here, what is the optimal assumed interest rate? I mean, if you go out and you buy an IVA, and you could buy these things, ideally, what assumed interest rate would you like? And as I said, as you say here, the IVA pays the investor the ratio of the value of 1 unit of a portfolio of risky assets to the value of $1 growing at a fixed rate, and that fixed rate is the assumed interest rate. It turns out that the optimal assumed interest rate is the certainty equivalent return. So that certainty equivalent return number that we came up with, that we used to come up with the consumption divisor, is also the same number that ideally you would have in your in your IVA. Now, so how much? So if I was using IVAs, you know, how much payout would I get? Well, it depends on two things: how many IVAs you have, and how many, and also, what the what the payoff on the IVA is. Now, the payoff on the IVA is random. It's a market determined value, whereas the number of IVAs you can control. And what you notice here is that these are actually the same curves as we had back in chapter 5 when we were talking about with and without annuities, what level of consumption you have. So here, instead of the level of consumption, it's the number of IVAs you hold. And that's what determines then the actual level of consumption. Now, the reason we call this IVAs real and imagined, because you could do this with physical, actual IVAs if you get them. But even if you didn't have actual IVAs available to you, you couldn't annuitize. The spending rule, this model, the optimal spending rule, basically is to you can kind of think of creating an artificial IVA. Not you don't have the actual security, but you can work out if you did have one, what would its payout be, and you multiply that by the number of that you own, and that's your payout.
Oh, I think this is great, so great. We have about 7 minutes until the
Okay,
bottom of the hour. I just want to kind of raise it to your attention and see where you want to stop.
Right. I think we're in good shape to finish up the chapter and have a few questions.
Yes, I think we're actually almost done here. So this is when annuities are not available, what your discretionary consumption is. So it's no longer just a line. Now we can actually draw percentiles of that, and we can see it going up and then coming down because of the the effect of when you don't have annuities, you don't plan on consuming as much in your latter years. And now if we go to the next one, if you do have annuities, then these percentiles, then they all become basically almost linear, going up, because you can guarantee your income up to basically what the market is going to up to what the market's going to do, and that leads to this. And I think we're just about done here.
And
Yeah.
we are, and Paul, though I think it would be, again, so you got into the details and there's a lot of math. And again, I think that probably a number of us found it intimidating, and we're down in the weeds, and perhaps so far down in the weeds, we can't see the forest anymore, if you will. So we're kind of wrapping up, part 1 of the book, the life cycle model. And again, maybe high level, can you kind of take us to that high level of, what answers, what questions are we, questions and answers are we getting from the life cycle model?
I think the life cycle model, and in its full form, as we just were talking about, really answers all the main questions, that in financial planning. I mean, it's like how much should you save each year, how much you consume each year, how you should invest your portfolio, how risky should your portfolio be, when you should buy life insurance, when you should buy annuities, and so on, and the use of annuities, to help, to kind of help manage your consumption path.
A question we had gotten offline, that I think is kind of pertinent, is just, kind of the sequencing, there's kind of different models. Is it what, again, I think the question was really if when Paula's software is running on behalf of Isabella, what would be kind of the sequence that it would be using in terms of the models? Are they all bundled together? Is it happening in a specific sequence? how is that happening?
Well, I mean, the first, if you're using software like this, the first thing is, you gather all your information about your client, their income, their education, their age, when they want to retire. You would try to implement some kind of a questionnaire based on the principles we covered in chapter 2, to try to not only capture their risk tolerance but also capture their other preferences. And so if once you have all that, you can kind of push the button, and it will come up with the first thing, come up with the economic balance sheet. It will come up with some asset allocation for your financial assets. And then kind of, you move to the last phase here, which is, the implementation phase, what we call the grandchild, what we call the grandchild model at the end of the book, which is, how do you, how do you then implement those asset allocation recommendations with funds?
I have another question that I'll ask, but I'm going to pause temporarily and encourage you. We've got just a few minutes left. Does anyone else have a question for Paul or myself?
I think he mentioned it, but I'm intrigued particularly by the places where you believe that people are not doing the right thing based on the information that they're currently getting from their financial plan or the absence of a financial plan. I mean, in particular, you just keep on saying it, which is people aren't buying enough annuities that add value to everybody, and they're not being consumed enough. So do you agree? And are there other opportunities like that where if people understood the math that you're showing, it would speak to different behavior?
I mean, I think under-annuitization is certainly an important issue, but I think there's other fundamental issues we're trying to address here, which is how can a financial planner meaningfully have a discussion with their client about how much they should be spending every year? Because I think there's a lot of focus in practice on the investment portfolio. What funds should I be buying? And then I don't think there's a whole lot of discussions around, well, how much money should I be spending?
And so, Jim, I think it's a great question. I think just like annuities, life insurance is probably often neglected. Again, I guess I think Paul and I have been talking about this, a lot. Is what is wealth management? All too often, again, we feel like wealth management really boils down to, what funds should somebody be buying, when the financial planning aspect is kind of missing from the discussion. And to me, that's where, lifecycle models, the types of models that are associated with, numerous Nobel Prize winners, that piece is missing. Answering, how much should you be saving? How much should you be consuming? What types of insurance do you need, whether it's, life insurance or annuities, where you're insuring against longevity risk. In my mind, these are kind of first order problems that influence whether or not you're going to be successful in your kind of financial life. And these are the things that we want to get right. We are right at the top of the hour, and I promised that we wouldn't go over. So I will end it now. If people have questions, feel free to email us afterwards, and we'll try to take those offline. Thank you.